Hello and welcome to the Cube Talk Show. My name is Joe Barbieri and I'm your host, and this is a money show. We talk about all aspects of money. Today's guest is Promod Sharma. He's from Taxevity and he's a marketing actuary, and it'll be an interesting discussion. We're going to be talking about fee-only actuarial insurance reviews. And well, to start off, how are you?
I'm doing great, Joe. Thanks.
So just a little background. Well, we know it's involving insurance, but what exactly do you do and how do you do it?
Okay, so I'm an actuary by training, which means I'm experienced in measuring and managing risk. So my career has had three phases. First, I was an apprentice, so I learned how to become an actuary. Then I designed insurance products and helped advisors sell them. And for the last 3 years, since 2009, I've been helping the public rather than helping the insurance companies and advisors.
Okay, so I know there's a lot of similarity in how we're doing our business, in that we're going directly to the client and charging for the advice. So from what you've seen in the insurance part of it, how does what you do differ from the classical insurance broker or the classical products that you see?
Well, the classical model in the insurance world, and I believe it's the same on the investment side, is that advice is free. All you do is you buy these products and the people helping you don't seem to charge you anything. And as we know, you are actually being charged. The prices are simply buried in the products. And when you're not paying for advice directly, you don't really know what you are paying, and there may be biases in the advice. And so I wanted to be able to help the public get a second opinion on what they are buying without the pressure to sell something in order to make money.
Yeah, I'll second that on the investment side. The typical person, and I've actually heard people say this, so I'll use a bank as an example, but it's similar with a planner or with a mutual fund company. They'll go into a bank and they'll see somebody who does investments and they'll say, okay, how much money do you have? We'll allocate it into X amount of funds, and that's it. And there's no visible check being issued, there's no visible invoice, there's no visible fee of any kind, but it's all built into the return. And I've seen some of these people come after the fact and say, well, I've bought these products and nothing seems to be happening in terms of growth, in terms of return. Now, the market has something to do with it, but when I look at what they have, I know what the fees are, and then I usually ask them, so how much do you think all of this costs? And the word free comes up most of the time. And I say, well, it's not free, it's embedded in the price. And usually a look of blank refrigerator door comes back to me saying, what do you mean? You know, if I don't write the check, I don't pay. Well, not really. You don't pay this way, but you pay that way. And when I've explained how they pay, it suddenly changes the whole story. And the extension of that story was, I've had these products for so long, I'm not getting what I'm looking for, and then why not? And when I look at the fees only, I say to them, well, by the way, if you just got a cheaper product, you would have X dollars more than you currently have. And it's a fair amount of dollars, because people think about retirement, and if you're 30 years old or 40 years old and you're going 30 years away and you're saving 2% of your money for 30 years, that's a minimum of 60%. With compounding, it's probably more.
Right.
So that's a lot of money. Now, are you finding that's happening with insurance?
Yes, pretty well the same thing happens on the insurance side. So if you go to an institution like a bank, they have a lot of overhead, and the people working there are essentially employees. Granted, they're commissioned, but they're employees, and they'll have goals for them to bring in revenue. And if your goal is to bring in a certain dollar amount, then would you sell inexpensive term insurance, or would you sell more expensive universal life or very expensive whole life insurance? There are some conflicts created there because people want to do well in their work. And the public doesn't have an idea of how much compensation, at least on the investment side. If you want, you can look up the management expense ratios and get some idea of what they are. With insurance, there's no disclosure like that. And unlike investments where the expenses are level year by year, with insurance what happens is most of the money is in compensation is paid right at the beginning, and then it drops very dramatically after that first year, and little is paid in renewal years. And what that means is that there's a strong incentive to sell, and there isn't much of an incentive to provide after-sales service.
So is there a difference? Is there a difference in quality between product A and product B? I know for a mutual fund the story is, so the active and passive argument. The active argument is the person that picks the stocks, so they're doing work to research and trade and provide a return. The passive way is just to buy an index and just wait, and it copies whatever the index is doing. The intuition says that this person doing this work should do better because he's doing the work. The results say mostly the opposite. It's not 100% of the time, it's about 70% of the time that person doing the work isn't providing the result, and only 30% of the time they are, but everything's assumed to be of the same quality. Do you have that same experience?
Yes, in insurance, the most basic product is term insurance, and with that you buy term insurance and you simply invest your money outside. So that's called buying term and investing the difference. If you want, you can invest money inside an insurance policy also, because when you buy insurance there's an envelope that allows tax-sheltered growth, and if you want to make the decisions yourself, you want to be more active, then you can buy universal life insurance, and then with your advisor you can select different types of investment choices, like things that are similar to mutual funds, things that are similar to GICs. And if you don't want to make those decisions, then you can take a passive approach and buy whole life insurance, where the insurance company makes all the decisions on your behalf.
So it'll depend on the person, what their needs are, which one is recommended, is that?
Yes, but it also depends on the salesperson. So from an advisor's point of view, the least effort is in selling whole life in terms of the maintenance, because there the client simply pays the premiums, the insurance company credits whatever returns they're able to earn. With universal life, the advisor needs to actually monitor those investment choices and then make changes from time to time. And so depending on the skill that the advisor has, for instance, some advisors will also sell investments, so they may have a tendency to sell universal life insurance. If you're buying from a bank where the advisor who sells insurance is different than the advisor who sells the investments, there you're more likely to get something like whole life. Not only does it pay very good compensation, the insurance salesperson doesn't have to worry about maintaining that policy after it's sold.
So I think you've already answered this, but the investment portion of the insurance, like I'm hearing people say that, I guess it's basically an annuity where you're buying it strictly to generate a return, and then you can take the money out later on or borrow against it to to invest it primarily. Is this is it the same sort of rules where you have to do your homework on these? And
yes, you do definitely need to do your homework, because a salesperson is trying to sell a product, and in order to do that they're looking for glitzy things to make the product look even more shiny and appealing than it might otherwise be. The way I look at insurance is based on the actuarial principles that you look at the need that the person has. If the person needs insurance for a limited period of time, say that's for a mortgage or because they're children in school, then term insurance is a very good solution. End of story. If the client has a permanent need, then say for estate planning purposes, etc., or they want to give money at the time of death, then that's where permanent insurance is needed. And so the first decision needs to be whether the need is temporary or permanent. Now, if the need ends up being permanent, then there are tax sheltering opportunities. Because if you look at insurance at its core, there's a chance of us passing away every year, the mortality rate. And that mortality rate starts off small, and then it keeps growing and growing and growing as we get closer to our life expectancy. So if we were paying for the insurance year by year, then the premiums become unaffordable at the time the insurance is most likely to pay out. The government realized that that didn't make sense, because if people don't have insurance, then there's a burden on society. And if you're buying something where it becomes more and more expensive every year, then that's unsustainable. And so the government decided that they would use the tax system to provide incentives for people to save to pay those later insurance charges. So when you buy permanent insurance, there's an envelope that lets you get tax sheltered growth. So in essence, it's like a pension. You're putting in extra money now and it grows, and that gets used to cover the charges later on. And when that money is in the policy, then there are creative things that can be done, such as withdraw it, borrow it, all sorts of things. But sometimes the glitzy aspects overwhelm the underlying need, that is, do you need insurance for a short time or do you need it forever? And that is unfortunate, because people like nice and shiny things. We see that every time Apple releases a new iPhone.
Which is recent. Well, for that universal life, the taxes are going to be a big factor in that decision, isn't it? Because most of these are tax exempt, aren't they, or tax deferred, I guess.
Yeah, tax shelter is probably the better term, but some people will call it tax exempt, because technically it is tax exempt, but it's exempt from annual taxation. It's not exempt from taxation in total. So if you were to withdraw the money, then there is tax, just as if you took money out of an RRSP. The only time it's really tax-free is if the money stays in the policy until the time of death. Now, the drawback with the investment choices inside insurance, with whole life you have no choices. The insurance company is just deciding on your behalf. And so that has some implications. It's simple for the buyer, but at the same time, they don't really know what the insurance company is doing. With universal life, what happens is there are investment choices, but the investment expenses are relatively high. So you cannot have low-cost options like ETFs. You get things that are closer to mutual funds. And if anything, inside insurance, the costs are even higher than outside, because there's a hidden tax the government levies on insurance companies called investment income tax, IIT, and that might be about 50 basis points. The government charges it to the insurance companies, but they really don't want to pay it, so they just tack it on to the investment expenses. So generally speaking, any investment inside an insurance policy will cost more than that same investment outside because of that tax.
So if there's say a Canadian equity fund, a mutual fund, and the MER is 2%, 2.5%, if you had that inside an insurance policy, would that, okay, so there's a 0.5% government tax, but would the MER itself be 3%?
It'd be about 3%,
That's
yes.
sort of what to expect. Is there any way to find that out when you're buying it?
Well, companies will show what the current management expense ratios are, and they'll show what the maximum is. So if you look at your contract, and reading a contract is not much fun, there it will be stipulated what the expenses are. But there is a caveat. The insurance company usually reserves the right to withdraw any investment choice that they choose. And so if there's a choice that has a 3% MER, and for whatever reason they decided that they needed higher MERs, then they could withdraw that choice and introduce another one that has higher expenses. I don't think that has happened, but those are the types of things that are in insurance contracts that people don't think of.
Is it advised that somebody get an actuary, a lawyer, to read these contracts prior to signing up?
Well, the problem is that you cannot negotiate the contract. And so if you say, well, I don't like this provision, then the insurance company will say, well, don't buy it. Because it's not something that you can negotiate. So the contracts among companies tend to be pretty similar. And in Canada, companies run pretty well. We didn't have the type of financial turmoil that other countries experienced. And that's because of the companies, but also in large part because of the strict government regulations. The big problem that arises in insurance is not so much at the insurance company level, but more with the advisors. Because to sell insurance, there's very little skill required. You need to pass a multiple choice exam, and all you need to do is get 60% correct on that. And then, assuming you're not a criminal, things like that, then you can be licensed and start selling insurance. There aren't any real requirements saying that you need to have a certain level of education to sell these types of policies.
So, since we're talking about that, so that's to get started. Is that multiple choice test, and is there any like securities course or something ongoing that people would do?
People who sell insurance can also sell segregated funds. That's part of their license. And as we know, segregated funds are more expensive even than mutual funds because the insurance company is now providing a guarantee, so that adds to the costs. There are continuing education requirements. I think advisors need to get 30 hours of continuing education every 2 years. So there are some basic things like that that are provided. Some advisors might get licensed to sell mutual funds, but if you look at the whole range of investment choices, we know the least expensive choices are things like ETFs. A typical advisor would not be licensed to sell those kinds of products. So when they're giving advice, they're only offering suggestions from the small subset of products that they're allowed to sell.
Is there any, well, from my end of it, it's kind of interesting in terms of the regulation. It's quite a range. So mutual funds have one license.
Mm-hmm.
If you're selling stock, that's a different story. There's another license.
Mm-hmm.
And then there's, well, insurance is completely different. But there's a series, and then for exempt product, there's another license, and that's for higher end people, and or they call them accredited investors.
Right.
People that are people that should do their own homework is how I sum that up. And so you don't need to tell them as much. You can say, here are the particulars, and you know, you have to buyer beware kind of thing.
Whereas, but as you're saying, each of these areas is quite specialized, and so it would be difficult for one person, no matter how good they are, to be very experienced in all of these areas. So in my case, the only thing I've ever worked on my entire career has been life and health insurance. And so I wouldn't give any opinions relating to investments or employee benefits, real estate, any of those things. But there are people who will provide advice in different areas. I don't know how they can, because I feel that even in the narrow field of insurance, there's still so much to keep learning and to stay sharp with.
Okay, we're going to take a break for a few minutes, and we'll continue. We'll continue with Promod after the break. Hello, and we're back on the Cube Talk Show, and we're here with Promod Sharma from Taxevity, and we're talking about insurance. And well, I'll start the second half with. We talked a bit about life insurance. Well, maybe you could expand on life insurance for estates. I guess that's all treated as one topic, or is there specific offshoots of like life insurance for taking care of your children or for tax benefits?
Yeah. Well, life insurance is ultimately a death benefit, so it can be used for different purposes. So the two main categories are temporary insurance and permanent insurance. And what happens with people is that as they get older, they've accumulated more assets, and there's a large tax liability that's due at the time of the second death. So if there's a husband and wife, then the assets can be passed from one to the other. But then when that second person dies, then our government likes collecting tax, and insurance is a way to pre-fund that tax. So instead of paying potentially hundreds of thousands of dollars in tax, you could buy a death benefit of that same amount. A simple example would be an RRSP. So if someone has, say, $500,000 in an RRSP, then if they were to pass away, then about half of that goes into tax. The client could buy $250,000 of permanent life insurance to cover that tax, and the premiums would be well below the $250,000, especially if they buy that earlier on. And also with an estate, what happens is CRA likes to get their money quickly. And so it could be that there are good assets in the estate, but the markets are bad. And CRA would just say, well, you owe us this amount of money, sell it, and it may not be opportune. With insurance, what happens is that there is liquid cash payable within days or weeks of a claim being filed, and that can be used to provide liquidity to an estate.
So the response time is that fast?
Yes.
If there's a death within a week or a month?
It varies depending on the circumstances surrounding the death, and there's some information that needs to be collected. If the death occurs in another country, then it may take a little bit longer. But insurance companies are in the business of paying legitimate claims. And so they don't want, and it's a very emotional time when someone passes away, so they would like to pay those claims efficiently. Now, there'll always be some examples where something happened and it took longer, but those would be the anomalies rather than the normal cases.
So I find it funny they call it life insurance, but it's really about death.
It's a marketing term, because really, if you called it death insurance, who would buy it?
Yeah, we used to have jokes when I worked. If you put the word death instead of life in all the insurance company names, they don't sound very appealing.
Right, yes.
So I guess that's exactly what you're saying. The Great West Death, as an example. You know,
well, I was at a conference this weekend, the Canadian Personal Financial Bloggers, and there were speakers from various groups, and one of the speakers was saying that the financial world has become a lot more complicated than it used to be. That in the past we would have defined benefit pension plans, life was just simple, and now what's happened is a lot more risks have been put on our shoulders, and we haven't really received training to help deal with those risks. And he also went on to explain that if you look at the financial sector, some of the sharpest marketing minds in the country are working there, but they're really working for the shareholders to increase the returns to them. And the dilemma is that the public needs education, but how do you get that education from the people selling you the products?
Yeah. Well, I used to work in one of the marketing groups in one of my previous jobs, and there's actually a lot of intelligence that's in the finance industry. A lot of scientific minds, a lot of engineering minds, a lot of mathematicians. A lot of them end up in the trading, modeling, risk areas, but they tend to disperse among research, marketing, because there's money there, and the money is ongoing. But so yeah, just to second that, I've seen that, and it's been going on for, I'd say, at least 20 years. That flow of people has been coming in, because I have an engineering background before finance, and a lot of engineers went into finance because they said there's money there. And even people that worked in the mines, the geologists, the structural engineers, the electrical, they just say, oh, change the names, put some financial names, run the model, boom, this can make money on a spread of bonds or whatever it is, and I'll get $1 million a year and I can go home. And that's what a lot of them did.
Right. Unfortunately, I mean, big companies can afford to hire that kind of expertise, but the general public cannot. And so in what you and I are providing, we're letting individuals have access to the kinds of resources that might previously have been limited to multi-billion-dollar insurance companies or other types of investment companies.
Yeah, we're attempting to balance the field. So, so in terms of insurance, well, we haven't covered health insurance. What? Well, I've heard about critical illness insurance. I've heard about
maybe disability insurance.
Disability
also.
insurance. So, what's the general primer for that?
Yeah. So those products, again, this is a marketing name, are called living benefits because you can get the benefits while you're still alive. And in many ways, these living benefits are more important than the life insurance. If you look at life insurance, for many people, term insurance would be sufficient. And term insurance is not very expensive because there is a very small chance that anything will ever happen to us. So it's almost like a lottery. So you can get $1 million by just paying maybe hundreds of dollars. But what people need more than that. So I'm not saying don't get life insurance because it's still a very good form of protection. But in terms of something that's more likely to pay out, health insurance is in that category. If you look at disability or you look at critical illnesses, then there's a much greater likelihood that during our working years, one of those things will happen. So disability insurance deals with morbidity. So that means that we're not able to work. It could be through sickness or illness or blindness. It could be lots of different things. And then here is a way to have income coming in on an ongoing basis, depending on what the product is structured as. With critical illness insurance, what happens is something very serious could happen to a person. For instance, they might have a stroke or a cancer, these horrible things. In other countries, they call critical illness insurance dread disease insurance because it's actually these really scary things that get covered by it. And with critical illness insurance, about a month after a condition occurs, there can be a lump sum provided to help cover the costs. So for instance, we have a healthcare system here in Canada, which again seems free because we don't have to pay so much when we go to hospitals, but we pay a lot in time. With critical illness insurance, there's money there so that if someone wanted to get treatment more quickly, then they could perhaps go to the United States and have the treatment covered there. Or in some really sad cases, maybe there's nothing that can be done for that person, but maybe the money can be used to bring family together or go on a last trip, different things. And it isn't possible to get money like that from other sources. So if someone is, even if they're single, like if someone is single, they probably don't need life insurance or they don't need much of it because they don't have any particular beneficiaries to leave it to. But if they're single, then having disability insurance or critical illness insurance could mean a big difference in their lives if anything unfortunate were to happen.
Because they're not being taken care of by their family or the usual people who would do that.
Right. And also with critical illness insurance, there is a feature called a return of premium, because from a psychology point of view, because we know that we have very clever people designing these products, I used to be one of them, people don't think anything will happen to them. And so it seems that if you buy insurance and nothing happens, it's a waste. Actually, it's better that nothing does happen, because if it did, then that would be quite unfortunate. And with car insurance and home insurance, we pay these premiums and nothing happens and we don't think much about it. But with critical illness insurance, you can have a structure where you can get your premiums returned to you, say at age 65 or 70, if you have not had a claim. And so in essence, you can take money that you might otherwise be setting aside for retirement savings and buy critical illness. If something unfortunate happens, there's money to cover that, which helps with the retirement savings still grow. And if nothing happens, then that money can be taken at the time of retirement and be used for retirement savings. So sometimes there are interesting combinations of benefits that can be added to products like life insurance or health insurance.
Now these are over and above the government. So for example, somebody gets injured, they're entitled to disability benefits. That's given by the government, like a basic.
Well, I'd have to check into the details, but the government does not provide very much in the way of disability. if someone who works for a company might be covered under a group plan there, and that could provide reasonable benefits. But even there, a private plan would provide a higher level of benefits. But the thing that keeps people away from disability insurance and critical illness insurance is the cost. Because it's one of those areas where you get what you pay for, and because there are pretty good chances. You see scary statistics, say 1 in 3, 1 in 4, where bad things can happen to us during our working years. And so that means that the premiums are relatively high because those claims are relatively high. And one of the mistakes that people sometimes make is that they don't understand the differences among companies and products. So they look for the cheapest coverage. What they don't realize is that the company that has the cheapest products may have made mistakes in their pricing. The premiums are generally guaranteed, so the only way the insurance company could recover their profits would be to maybe be a little bit tougher on claims. And so it's better to pay maybe a little bit more, and generally it's not a lot more because there is a lot of competition in the sector, but maybe pay a little bit more and buy from a company that is known to have good corporate governance, which is a measure of them keeping their promises to their clients.
Is there a way for people to know how good the governance is?
Yes, the Globe and Mail does an annual survey. They call it Board Games, and it comes out towards the end of the year. And it looks at all the different companies on different measures. And so if a client needs insurance, I would generally recommend that they deal with a company that's among the top in corporate governance. There are some insurance companies that are not even in the top 100, and unless their prices are that much lower, there's an additional risk that clients are taking by dealing with companies like that. So advisors have access to this kind of information also, but I rarely see it being presented to clients to help them make their decisions.
Very interesting. So back to the beginning, the actuarial insurance review. So what is that exactly? What's the process of that?
Okay, so what happens is that there'll be people who have decided that for whatever reason they don't fully trust their advisor, because if they trusted their advisor, there would be no point in them paying money to me to look at what their advisor did. So there's something that's bothering them, and they're not really sure where to go for a second opinion, because they can't just go back to their advisor. If they go and talk to another advisor, the only way that advisor gets paid is by selling something else, so there are some conflicts there. So what happens is clients will come to me because there's something bothering them, and there's a 3-step process. So the first step when we meet is to help understand what the issue is that is bothering the client. It could be something that's immediate, short-term, or long-term. And then the client will also leave their documentation to show what protection they have in place. Then I'll go off into my actuarial cave and do all sorts of calculations, read things, etc., and see what might be needed by that client and compare it with what that client has. And then in the next meeting, we'll review the findings, and then the client can decide what steps they would like to take.
So it's a second opinion.
Yes, exactly.
In a nutshell. Yeah, from my experience, I've had that on the investment side. So when I do the initial conversation, the question I'll ask is, well, what do you need?
Mm-hmm.
Or what are you looking for? Which is basically saying, what is it that's bothering you? Because a lot of them have a plan already. They have a list of products already.
Mm-hmm.
And so they'll say, the return isn't there. The cost usually doesn't come up because they're not aware of it. That comes later. But the return isn't there. The markets aren't doing very well. In the last 5 years they haven't, which actually has been a boom because it's getting a lot of people to rethink the whole retirement, what's possible, what isn't, what they're able to achieve. This is actually interesting. The planners used to have a set of numbers, assumptions for calculating a retirement. based on your age, the number of years, how much money you put aside. And they've had a lot of ads doing this. If you put $100 a month for 25 years and you get a 6, they used to say 8% per year. Now they're saying they've dropped it down to 6.
Right.
I've seen people now dropping it down to 5, dropping it down to 4, because we've had these really low interest rates. And now we have the Federal Reserve saying 0% until 2015. And we're in 2012, so this could go on another 10 years, who knows. And so all those assumptions have to be brought down. But when you bring an assumption down by 1%, you're skimming off 50% of your retirement fund, potentially, or 20%. So from $1 million, now you have $800,000. And that sounds like a lot of money, but if you try to live off of that for 30 years, and you're not getting a return, suddenly you don't have enough money. And one assumption like that can change your whole strategy. And so, so people are, because the markets haven't been doing so well, people are coming and saying, I was expecting 6% a year and I've gotten 0 or negative or 3 or 5. Can I still do all of this? And so there's a lot of rethinking happening in the investment thing, and a lot of it is second opinion, saying, yeah, I've got a plan, but does it still work?
Yes, what happens on the insurance side is a little bit different. So I won't see many people at the time they're buying something, because they're the advisors taking care of them and doing all sorts of nice things. They think they're being very well looked after. But what happens is, because the compensation is paid primarily at the time of sale, after a year or 2 or a little bit longer, they start noticing that the advisor isn't calling them up much anymore. So maybe after 3 or 5 years, if they hear from the advisor, it's not to service what they have, but to sell them something new. And then they start thinking, well, wait a second, I'm not getting a lot of service. Maybe what I got isn't really the right thing. Because with insurance, you can't just leave it there. You need to monitor it and make adjustments, make sure that it's still suitable. The insurance companies have been having a very tough time because of the economic environment. And because what happens is, when you're buying permanent insurance, you are giving money to the insurance company and they invest it to help cover the charges later on in time. And they don't have any magical investments that can credit really high returns. So in the last couple of years, the insurance premiums have been going up and up and up. And the trend is to keep those increases, is to expect even more increases. And that means it's very important for clients to look at their current insurance, because there may be options in those policies that are very advantageous that they are not looking at. With an insurance policy, there are generally investment choices that are like GICs, and they generally have minimum interest rate guarantees that might be as high as, say, 3%. I actually have a policy that I bought that has a minimum of 4%. And so that's essentially a put option that the client has. By putting more investment money into that option, they can then earn that guaranteed rate, or let's say 3, because the 4 disappeared years ago. But once it's in a policy, it cannot be withdrawn. And so they can put money, and now they're earning, say, 2-3% in a tax-sheltered environment. That can be very attractive. But sometimes advisors want to sell something new instead, and what's new may actually be worse than what is currently in place, but the client may not know, because there are all sorts of reasons why this new thing looks so shiny and appealing, but at the same time other things are being taken away, and an independent review helps determine what the implications are of making changes.
So as a hypothetical, so you're a person who goes to advisor A, buys some insurance, they get compensated up front mostly, then it starts declining. 4 or 5 years later, you say, you know what, maybe I should change this. So you now go looking for a new product or get introduced to a new product. If you buy a second product, are you paying a large fee again? Like, is it
Yeah, well, first of all, it's unlikely that the client would say, let me buy a new product, because these are not like iPhones where people want to keep getting the latest. It's more likely that the advisor would be coming back and saying, here's something new and fresh and shiny that you should buy instead. And the advisor then gets paid all over again because it's a brand new sale. What people don't realize is that for the insurance company, it's also advantageous for that old policy to be canceled. Because what's happened is that you have been paying money to that insurance company and they haven't had to pay anything back to you. The longer that policy stays in force, the greater the chances are that they'll have to pay something. Now, if they are able to get rid of that policy, then they have actually earned profits. They don't want to get rid of the policy in the first few years because there are costs to issuing the policy, but after 5 years, 7 years, it's good for them to lose that policy. And so the advisors, it's not surprising, are incented to sell something new. Now, when you get something new, the guarantees may be worse, and there are also new provisions because there's new underwriting now, and with the advancements in medical technology, it could be that what you were insured for before you're not able to get anymore, or it'll cost you more. As a minimum, the premiums will be higher because if you last bought 5 years ago, you're now 5 years older.
Yeah.
And so even if prices drop by a certain percentage every year, as seems to be the case with term insurance, your premiums will actually be higher. And so it ends up being pretty complicated, but it's very important before someone gets rid of an insurance policy to make sure that they know what they're doing, and if they are planning to buy another insurance policy, to make sure that new policy is in place before they get rid of the old one.
So is it a given that if you were to cancel an old one that the benefits are lost, or is there an opportunity to roll it into a new one? Does that kind of thing happen, or is it?
It's very difficult to add on to an old policy. Now, if you have universal life insurance, then you could add additional riders. So for instance, maybe you have another child and you need term insurance for 10 or 20 years. Then with the universal life policy, there could be a rider that's added on, or there could simply be a standalone policy that's purchased. So sometimes there are adjustments that can be made, but other times it's extra coverage that's needed.
Okay, we're pretty much almost finished in time, but if you'd like to give a contact information, a website, or an email that if people wanted to contact you and discuss
Sure.
insurance further.
Sure, the best place to go would be the Taxevity website, and Taxevity is taxevity.com, and there all the contact information is provided. The fees are shown for the different services. The idea is to provide a lot of disclosure, and also I've been blogging for 5 years, so there are over 500 posts that go into more detail on different things, because as part of my commitment to educating, I put as much as I can online for the benefit of the public.
And is the blog on the website as well?
There are links to the blog also, yes.
Yes, okay. Okay, well, thanks for coming out. That's was very good.
My pleasure.
So that's our show for today. That's the Cube Talk Show. To see any past episodes, they're on my website, www.joetheinvestor.ca, under the In the Media tab and the Cube Talk Show. My email is joetheinvestor.today@gmail.com if you want to contact me. And that's it for today. Have a good evening.